Hello and welcome to another in our series of Deeper Insight videos where we bring together members of the Westpac economics and strategy teams to discuss macroeconomic developments and markets that could impact our region. My name's Robert Rennie and I'm joined today by senior economist and commodity expert Justin Smirk. Welcome, Justin, and I'm really looking forward to our conversation on commodities and supercycles. So it doesn't really matter whether you watch widely traded commodity markets like crude oil or copper, or more narrowly traded ones like iron ore. We've seen some breathtaking gains across pretty much all of the commodity complex through the fourth quarter of last year and first quarter of this year. Copper jumped 35% over that 6-month period. Crude oil rose by circa 47-48%, and iron ore by between 55 and 60%. I was listening to a podcast over the weekend that noted that US lumber prices were up by 130% over that Q4, Q1 period and are up 25% so far this quarter. And not surprisingly, those gains across the commodity complex have prompted talk that we're in a new commodity supercycle. Now, personally, I'm not really a believer in this being another commodity supercycle along the lines of the emergence of China through the last decade. Rather, I tend to see idiosyncratic short-term supply and demand shocks as key drivers of commodity prices in each of those markets. I remember publishing a video back in December when I noticed the incredible records that were being broken in China in terms of steel production and the impact that this was having on iron ore prices. Well, that story has continued through this year so far. In fact, seasonally adjusted March Chinese steel production came in at a fresh record high of 95.5 million tons, much to my surprise on Friday last week, given headlines of steel restrictions in March. Indeed, in 11 of the last 12 months on a seasonally adjusted basis, we've had sequential records in Chinese steel production, and this incredible run of record steel production has lifted Chinese iron ore imports back up to long-term trend, which has been running at circa 5 million tons per year for the last 15 years. That's a very sharp and very positive demand shock. In the face of this explosion in demand for iron ore, we've seen a series of one-off weather events and other significant issues that have essentially left exports out of combined Australia and Brazil essentially flat for the last three or so years. So I can see why this massive positive demand and mild negative supply shock has seen iron ore prices double from sub $90 a year ago to circa $177 in recent days, just below those peaks seen at the peak of the last commodity supercycle in 2011 when iron ore traded above 180. But Justin, less about me and how I'm thinking about what's driving commodity markets at the moment. What are you thinking in terms of commodity supercycles and the commodities that you're forecasting?
I guess the thing that's key to me, Rob, is breaking it down into sort of those long-term and short-term effects. You're right, we're in a very strong sweet spot right here, right now, and we're talking about a global recovery, not just what's going on in China now, but as you pointed out, lumber prices in the US is pointing out what's going on in the US as well, with a strong recovery there. We've got liquidity being flooded into the system, and we've got global trade now recovering back to more normal levels. All of it points towards being a super sweet spot for commodity prices right now and why they can get a good push. Now, it's very comfortable to talk about those sort of issues around supply and demand, much more conservative mining companies out there. We've got an investment profile that is softer. We've got ongoing constraints around supply, reasonably robust demand, all suggesting commodity prices can remain higher for longer. But is it a new emergence of a billion people entering the market, soaking up supply, mining companies having no idea what's going on and being lagging behind? No, it's not. When people talk about a supercycle, they're talking about multi-years, decades running long, where there's an imbalance between supply and demand. What we're talking about here is a tighter market, but one where everything at the moment is pointing in one direction and pointing up, and that suggests we can have higher prices for longer, and even in the short run, hitting new highs.
Now, it's interesting that you make that point. I remember listening to the video that Elliot Clark and Richard Franulovich did fairly recently talking about the Build Back Better infrastructure program in the US. And I guess thinking about recent developments there, I mean, is there a possibility that that very potent combination of Biden's infrastructure plan, remembering that China has this very aggressive peak carbon by 2030 and zero carbon by 2060, we've got the European recovery plan, very much focused on environmental sustainability as well. is there a risk that it's not so much a commodity super cycle as an infrastructure or build back better super cycle that really drives the kind of markets that will be in very heavy demand? So I'm thinking copper, nickel, aluminium, steel, maybe even cement as well. Is there a possibility that that's really the driver over the next couple of years?
Well, that's going to be an important part of why commodity prices can remain higher for longer, because we're talking about new demand situations coming through, new points. What is also you can note in the backdrop of all this is, while we spend a lot of time talking about China, is global steel production now outside of China is now back above where it was pre-COVID. So you've seen a strong global recovery coming through as well, which has been adding to it. But that build back better, green, that is part of all the ongoing scenarios of why you can get higher prices for longer. But we need to be really careful about how we think various commodities. There's certain supply situations which are changing. You talk about China and the desire to go towards lower carbon emissions. That points towards using electric arc furnaces, which uses more scrap steel. The market's maturing in China, get more supply of scrap. Again, the same with copper. You look at the situation where, yes, there's tight supply situations and some imbalances, but every time we've been here before, we see new supplies of second-hand scrap copper coming to the market. They find it wherever, and we find increasing uses of alternatives like aluminium. So while we can use this as a framework for talking about why commodity prices can remain higher for longer, it does not mean they only go in one direction. It means they can stay high, but we get these bubbles of short-term supply shocks and demand shocks, which produce rallies up. Then we get some corrections coming through, and then moving back up again. So it's more about talking about this area of volatile prices at high levels rather than one-way street.
What about the supply side as well? I mean, I talked before the idea that we're seeing a very strong, consistent, steady trend in terms of Chinese demand for iron ore, but the last 3 or 4 years, essentially supply out of Australia and Brazil has essentially been flat.
Sideways.
I could look at the same for copper. Copper mining production over the last 3 or 4 years has essentially been flat. There's a lot of noise in the data. And the fourth quarter of last year, we saw a reasonable pickup, but we're still really talking about 1% on a 3-month year basis. So what's it going to take to incentivize mining companies to get out there to invest more in increased copper, increased aluminium production, given the potential for that demand over coming years?
It's the ongoing battle between the degree of risk involved with a multi-year, multi-decade investment into a large project versus the short-run benefits. This transition period we're facing going towards being a greener and better future, we're not talking decades here. This is a transition that wants to be completed within a decade. So it's a much more shorter extreme shock. And that's why we're in it now. That's why we're experiencing these prices. And that's why mining companies are going to be conservative, which is why we have to keep on thinking about there being upside risk to prices while not getting too carried away with an idea that this is just going to be 10, 15 years of ongoing high prices that can just last because you've got this new demand constantly being recreated the whole time.
Okay.
We're more sort of we're in that structural change point right here, right now, which is giving us all the signs going in one direction, which is why prices keep on being pushed higher.
And obviously the implications of that, that point that you're making, really, that mining companies are probably more focused on cutting costs than in getting out there and investing. I mean, that's certainly a positive outlook from a credit and from an equity point of view.
It is, but it also is a very real signal too in the most recent commodity prices. Those who are watching the market would have noticed nickel prices have actually corrected. They corrected because nickel prices were being driven by this enthusiasm for using nickel in batteries. And lo and behold, they started developing new technology which they can use laterites, that sort of gravelly stuff they get from Indonesia, which contains some nickel. They can now convert that into nickel that can be used in batteries, battery grade. So we've got to be very careful about all these situations with how commodities are evolving, and why we can talk about, even I'm comfortable with the idea that a decade from now, commodity prices will be higher than they were pre the Chinese mining boom. We're still talking about good profits in the mining sector, good rates of return. Just not talking about a one-way bet the whole time.
That's a really good point, Justin. All right, let's bring it back to Australia if we can. Looking at the importance of iron ore and in particular iron ore prices to the overall value of goods and goods exports from Australia. Not putting any pressure on you, but given the importance that prices have really played in recent years, what are you forecasting through this year and next year, and any other thoughts on the outlook for resources in Australia?
So while there's some upturn momentum for iron ore prices in the near term, by the end of the year we expect a little bit of a supply and demand rebalance to come through, so talking about $150 a tonne, and then the ongoing recovery coming through from particularly the Brazilian supply and the shift towards scrap, taking it down towards $80 a tonne towards the end of 23. However, I should mention that we're a little bit more constructive around coal prices. At the moment, Australian coal prices are being hit really hard by the Chinese trade bans. We expect either the trade bans to be lifted slightly or the alternative markets to continue to grow for the Australian supply. So we see for the next 12 months at least some upside risk for coal prices, while we may be talking about weaker iron ore prices.
Many thanks, Justin. Some really good points there. So thank you again for your time. Well, that concludes today's Deeper Insight videos, and we have talked at length about commodities and super cycles. And I think if there's one key takeaway from my point of view, it's the idea that we could see commodity prices higher for longer, and certainly in the very short term, those commodities that are really focused on infrastructure, we could see some further upside risks over the coming year. Thank you, and we'll talk again soon.